Hi, I just want to talk a bit about Division 35 of the Income Tax Assessment Act 1997. This division deals with losses from non-commercial business activities. This division commenced on the 1st of July 2000, and it was a response to what was called the Ralph Review of Business Taxation. The rules in the division were further tightened up in 2009. The basic objective of the division is to prevent individuals from avoiding tax by carrying on unprofitable business and then claiming deductions for losses against other income in the same income year. Now, what this division seeks to do is it just says that individuals carrying on business activity either as a sole trader or in partnership cannot deduct losses to the business activity against other income such as salaries or wages. They must actually wait until the business makes a profit, and once it makes a profit, then it can deduct it from that profit. Now, if the loss-making business is a primary production or professional arts business and assessable income from other sources less than $40,000, basically losses can be offset from other income straight away. But for all other instances, at least one of the following tests must be satisfied. The first test is that assessable income from the business activity is at least $20,000. Now, a reasonable estimate means that, assuming that the business stopped operating halfway or 3/4 throughout the financial year, would it have gone on to earn $20,000? If yes, then this test is satisfied. The second test is that the business activity must have produced a profit in at least 3 of the previous 5 income years. The third test is that the reduced cost-based market value of real property or interest in real property used on a continuing basis in carrying on the activities at least $500,000. Now, this does not include things like fixtures that are attached to a dwelling that the taxpayer resides in. So, for example, let's say a taxpayer owns a bakery business and they use their own oven in their own home. You wouldn't count that oven as an asset. And the last test is that the total value of any other assets used on a continuing basis to carry out the activity is at least $100,000. Now, these assets include, let's say, lease payments or future payments of leases, including interest. It also includes patents, copyrights, and that sort of thing. Now, in 2009, there was some significant changes. If a person's adjusted taxable income exceeds $250,000, losses from non-commercial business activities must be quarantined. They do no longer meet the income requirement and cannot access these 4 tests that we previously talked about. Because they don't meet that income requirement, so it must be quarantined. Now, the rationale was of this change was that the current exceptions operate in a discriminatory way because high-income earners are more readily able to use the 4 tests or satisfy the 4 tests and then use them to avoid tax. Now, there's considerable argument about this. $250,000 is not currently indexed. The Farmers Union, I think, when it first got released, if you go to the I think it might be the explanatory memorandum, I'm not too sure, but one of them argued that it's not indexed, so it might seem like a lot now, but would it still seem like a lot in 10 years' time? So that's one of the controversies about this $250,000 threshold. Now, the Commissioner's discretion is quite important, and it just says that all taxpayers, regardless of income, can apply to the Commissioner to have losses deducted against other income in the same financial year. Now, all taxpayers includes those who did not meet the income requirement, which means that they earn more than $250,000. But generally, the taxpayer must prove that the loss was caused by circumstances beyond their control, or that the business will produce a profit or meet one of the 4 tests in a time frame that is considered commercially viable. Depending on whether the taxpayer met the income requirement, they will either have to prove that it will either meet one of the 4 tests or that it will produce a profit. And they do require external evidence, which is very important. And it's not intended to be available, the discretion is not intended to be available in cases where failure to make a profit is due to the nature of the business. It's not intended to be available in cases other than where failure to make a profit is due to the nature of the business. For example, if a business is starting out and they need to establish a client base, they might incur some initial costs, they may incur a loss in the beginning years of the business. Generally, those type of costs apply to all businesses, so the Commissioner's discretion is unlikely to be decided in favour of the taxpayer. In the 3 years leading up to 2009, an average of 38% of requests are decided in favour of the taxpayer. So this figure is quite old, but that's how that's the statistic at that time. Now, this is an anti-avoidance measure. The fact that the Act says that you could otherwise deduct under this Act means that it was set up under the presumption that the tax legislation would otherwise allow for such losses to be deducted under Section 8-1. And so it kind of aims to ensure that only losses from genuinely commercial activities are allowed as a deduction, and it makes pursuing unprofitable business activities less attractive. Now, just the final issues and concluding thoughts is that what constitutes a business is not defined in sufficient detail. In a few cases, for example, Kennedy and the Federal Commissioner of Tax, the taxpayer was a professional journalist and editor, and he did a documentary business, and he tried to claim deductions against the losses in his business against his other income, but the High Court or the court decided that it was more of a hobby or more of a lifestyle sort of thing, not really a genuine business venture. So Division 35 has not really defined what a business is in sufficient detail. And just finally, the Commissioner's discretion requires taxpayers to spend money to obtain external evidence, but even if they do spend that money to get that evidence, there's still no guarantee that they will be decided in favour. So it creates this uncertainty because then taxpayers are unable to predict what their tax liabilities will be. So they're kind of hanging in the loose about what's going to happen. And yeah, the Commissioner is put in a position of exercising discretion with little knowledge of the particular industries involved. So that's pretty much it. That's Division 35, and I hope I've given you some insight into this division. Obviously, it's not in detail. It's just a very quick summary of the division.